and we are going to go ahead and get started. So welcome everybody to the Woolen Mortgage Team Homebuyer Webinar. This is a live webinar. This is not pre-recorded, so it's a lot of fun. It's going to be interactive. So there is a chat option and there's a Q&A option. So I want any of you to jump in at any time and ask questions, communicate with us. We'll be monitoring that through the webinar. And don't be shy, because this is an interactive presentation. So welcome to my team. My Waterstone Mortgage is a mortgage company that is backing us, that we are hanging our license with. We are a mortgage banker, mortgage broker, and a bank. We are all of it. So we literally have every option under the sun to help you become a homeowner. And this is my 25th year in the industry. So my name is Sean Woland, and I am a mortgage expert here in the Scottsdale area, but I am available nationwide. Every state except for New York and Hawaii. So I apologize if you're from New York or Hawaii. But every other state I can lend in and help your friends, your family, and those that you meet. So we're going to start today. And so welcome to the Homebuyer Webinar. And here's my contact information if you want to jot it down, but I'll send it to you via email. You should have it all by now anyhow. But let's go ahead and get rolling. If I can get my PowerPoint to work. There we go. So today's topics are going to be based on the following. So first-time homebuyer programs, we're going to discuss that. We're going to go over what the qualification requirements are. We're going to look at how to calculate how much you can qualify for. So you know really, based on your circumstances, what you can qualify for. The steps to prepare. How do you prepare to purchase a home? Some credit tips and boosting of your credit. The benefits of home ownership. When you should buy. Like, what is the timing behind it? The difference between renting and buying, and some comparisons, and how rates work. We're going to talk about that. So when you ask, when you're looking at interest rates, there's a lot of different options, like how do they work? And then we'll finish off with the Q&A. Now, some of you had some questions that we had at the very beginning when you registered. I'm going to be addressing those at the end. So let's go ahead and jump in. And this is a really interesting quote, and it's a very interesting statistic. 90% of all millionaires become a millionaire through owning real estate. That's phenomenal. I mean, that is unbelievable. So if you want a better chance at becoming a millionaire, you better buy a home, because that's where 90% of all millionaires have gotten their millions from. So pretty phenomenal. So now's a very good time, if you haven't purchased a home, to start becoming that millionaire. So that was a quote by Andrew Carnegie. So you may see a lot of things on the news about different home buyer programs, first-time home buyer programs, grant programs. There's quite a few out there, and it's hard to decipher what they are, how to get information on them, what are the benefits of them. Each of them has their own little basic benefit that they're trying to help the consumer on, whether it's help somebody with lower credit, or help somebody that doesn't have any money for a down payment, or help somebody with closing costs. There's a lot of different scenarios, a lot of different programs, and these are a number of them. There's Home in 5, Chenoa, HomePod. I mean, the list goes on and on of those that is available, but I'm going to make it simple on you. I know about all of them. So what I do is I'll look at your scenario and we'll see what your needs are and pinpoint which ones are the best for you, because if you haven't seen or haven't heard of any out there, there's quite a few home buyer programs, especially available for first-time home buyers and for repeat buyers as well. So let's get into some of them. So the most common types of loans that are available are an FHA loan, which is a Federal Housing Association, the conventional loan, which is Fannie Mae and Freddie Mac, VA loans, which are for veterans, and then jumbo loans, which are a portfolio product, more of a private lending, any loan above $766,550. which is the maximum conventional loan limit. So we're going to go over all of these, but we have access to zero down for every single one of these programs. Now, VA is always zero down. It always has that option. But conventional traditionally requires 3% down, and then FHA requires 3.5% down. So we have programs in-house that allow you to do zero down with all of these, and without having to need the grant programs or the down payment assistance programs, which are actually very expensive. And we can go over that in more detail as well. Again, don't shy off asking questions if you have any. So one of the biggest questions I get is, well, what does it take to qualify? What credit scores do I need? what work history, like what will it take for me to qualify? And here's some basic, and we'll get into some other numbers later, but here's some basic numbers for you to really understand. Credit scores, FHA and VA, typically 580 credit score or higher will get you into the game. It means you qualified for credit piece of it. You now need to qualify income and everything else. Conventional is a hard line in the sand at 620 for a conventional loan, which is a Fannie Mae, Freddie Mac loan. Cash, how much cash do you need? Well, as little as $0 down. Now, to do a purchase where you don't have to come out of pocket with anything is difficult because we need the sellers. There are closing costs. So even if you have $0 down payment, there are fees associated with the transaction that they call closing costs. So there's lender fees, there's inspections, there's taxes, there's prorations, there's interest you have to pay at closing. There's a number of different closing costs. Typically, when you buy a home, that ranges between the $6,500 and $8,500, depending on the price of the home. So if you do a $0 down mortgage, you would still need closing costs. However, you can ask the seller to pay for those for you as part of the negotiation. So in a perfect world, you do a $0 down loan, so there's no down payment, and you have the seller cover your closing costs. Now, in different markets, depending on the timing of it and how long that home has been on the market, you may not get the ability to have the seller pay for your closing costs if there's multiple offers. So I would try to save up as much as you can for that, or ask a family member if they're willing to give it to you. But that's the minimum requirement, is those closing costs. And that's if the seller's not willing to give you those. Now, job history. For new people coming into the home ownership, a lot of them don't think they've been at the job long enough, or they think they need to be on it for 6 months or a year. If you went to school, let's just say you're a dental assistant and you went to school and you got your degree or your education at a dental school and you were there 2 years, we can actually use that as job history. You could be on the job for 1 day and we can use that income to qualify, because we need 2 years of total history in your field, whether it's education or work. And if you have multiple jobs, that's fine. We just need 2 years history. And as far as income goes, the hardest to get qualified is those that are self-employed, because we need 2 years worth of tax returns to prove that their ability to have a sustained income is there. So we need to show proof of 2 years of stability, and then we average those 2 years to qualify. But for the most part, whatever your salary is, whatever your hourly wage is, that's what we use to qualify. And then retirement income, Social Security income, there's annuities, we can use assets as income. If you have disability income, we can use that as income as well. So lots of different options there. But when you qualify, and we'll go over the numbers just shortly here, each loan programs have their own determining factors on how much you can afford within that specific program. So with conventional, it's called debt to income ratio. Your total debt, including the mortgage, compared to your income per month, can't exceed 50% on conventional. So if your income's $10,000 combined in the house, your total debts, including the mortgage, can't be more than 50% of that. So the mortgage and everything else can't be more than $5,000. We'll go over that in a second. FHA is a little bit more aggressive, up to 55. VA, you can go actually much higher. You can go close to 65, even higher sometimes, because it's based on a different factor. Jumbo is more strict. USDA is a little bit more strict, and we can go over that in more detail. Now, if you don't have enough income to qualify, but you have parents or family members that are willing to help you, you can always get a co-signer to add income to help you qualify. So that's nothing to be ashamed of. If you're a first-time home buyer, I'm helping my son right now do it. And I think every parent has the ability to do it if they can. It's a good way of getting your kids into a home early on. Remember, to become a millionaire, that's the key. What did I just do here? There we go. So what does it take to qualify? Those are your basics. Now let's look at how much you can qualify for. So I mentioned FHA, you can go up to 55% of your total debt to income ratio. So if you make $10,000 as a household, so both of you work, $10,000, or it's one of you, whatever it might be, let's just use 10,000, nice round number. You're looking at 55% debt. Your total debt allowed is going to be $5,500. So if you've got a $550 car payment, $250 in student loans, $150 in credit cards per month, we know based on this little formula there's only $4,550 left in that total amount allowed to allocate towards the purchase of the home. So we would use that $4,550, and that would be your cap payment. And then we would look at different properties and say, okay, based on that, looks like you're going to be able to buy a $600,000 home. And that's how we calculate how much you qualify for based on the debt to income ratio. So that's FHA, 44,550 in this circumstance. Now, conventional, a little bit more strict because it's only a 50 debt to income ratio. You're capped out at about 4,050 instead of the 4,550 with FHA. So it's a little bit more strict, but we'll take your total debts plus the new mortgage fees or mortgage costs and add that, and it can't be greater than that debt to income ratio requirement, which is 55, 50, or 43 in the others. So that's how I determine how much you can qualify for. Pretty simple formula, but I can help you with that at any time. So how do you calculate the payment so you know how much to add to that equation? Well, your mortgage payment is consisted of the mortgage payment itself, which, if you want to know what an amortization schedule is, it's kind of complicated, but your principal payment and the interest that you pay. So in the mortgage, you're paying yourself, you're paying the loan down, plus you're paying the interest. That, plus your property taxes, plus the mortgage insurance, and we'll go over that in just a second, plus any homeowner's insurance. That's if your house burns down, you don't want a mortgage on a pile of rubble, so you need insurance to rebuild it if it burns down. That's what that is. And then if you live in a property that has a homeowners association, there may be some dues for there, but some homes don't have that. That could save you a little bit of money. So all of those items put together would equal that total payment, and that's what we plug into your debt to income ratio. So when you make a mortgage payment every month, it's going to include everything except for the HOA. HOA is always paid separate, but it's going to include, for the most part, all of those items that I spoke of. So that's how we're going to calculate how much your payment is. Now let's go back to that real fast. Mortgage insurance. Mortgage insurance is actually an insurance policy that protects the lender. So if you're not putting anything down and you don't make your payments and they're missing out on those payments, and then we have to take the property back and then sell it and we get a loss, that insurance covers that loss associated with that. But if you put 20% down, there's enough equity there to absorb any loss, and we no longer require the loan to have mortgage insurance. So if you hear that myth that you need 20% down, it may have started because that's how much you need to avoid the mortgage insurance, but you can do 0 down, but it does have the mortgage insurance in it. So that's what mortgage insurance is, if you have any questions on that. Now, the pre-approval process, what does it take? So a pre-qualification is what most internet websites do. You go online, you fill out basic information, but it's garbage in, garbage out. If you answer the wrong information incorrectly, maybe it's on accident, maybe it's just because you filled it out wrong. Who knows? But online applications are, for me, they're not very good. So I like to do all my initial consultations, my loan pre-qualification meetings, in person, over Zoom, or on the telephone call, or on the telephone. And we do the initial loan application, which takes 10 to 15 minutes. From there, I do a soft credit pull so it doesn't hurt your credit. I will then review your credit. I'll go over all of that in detail with you. And then I'll give you a list of documents that we'll need for the full approval. But at that point, I can give you a pre-qualification letter. I've seen your income. We've talked about your income. We've talked about your assets. We've done the full application. I've seen your credit worthy. It's a soft credit pull, so it's not showing at all as an inquiry. It doesn't hurt your credit at all doing a soft credit pull. I issued that pre-qualification. And at that point, you can shop for a home. But it's not really 100% guaranteed because we haven't verified and validated everything. So step 2 is to gather those documents, which are typically your W-2s and your pay stubs proving your income and what you've made for the year. Your bank statements showing you have the money for the down payment or for the closing costs. Or if you're getting a gift from a family member, we need to show who the gift's going to be coming from. But those documents, along with your identification, will then, once we have that, we'll get the loan fully approved up front. And that's the difference between a pre-qualification and a pre-approval. A pre-approval, we've vetted the whole file. That loan is approved and ready to go. And when we issue it, once we have that done, it's only a 2-week closing. So a lot of people ask, well, how long is the process from the time I get qualified to buy a home? If you wake up tomorrow and decide, I want to buy a home, you can be in a home in 30 days. So the pre-qualification only takes a couple days to get everything together. The pre-qualification is the same day. The rest of it could take a day or two, depending on how long it takes to get the documents in. And then you start shopping for a home. It's as simple as that. So it's not a arduous task. It's there's a lot of documentation depending on how complicated your incomes are. If people have multiple companies that they run, there's a lot of tax returns to get put together. But if you're a wage earner, hourly, it's pretty simple. So preparing to buy. All of you that are first-time home buyers are wondering, well, I'm not going to buy for a couple of years. Like, what do I need to do to prepare? That's probably the most important part to start. Most of you, when you come to me, you'll say, I want to prepare to buy a home. I don't know what I need to do. And without knowing it, you're already ready. So let's look at some of the things we need to do to prepare to buy a home. First off, I urge you to put together a budget. So I've got some really cool personal budget spreadsheets. We need to know how much your expenses are monthly, all your streaming stuff, which is getting out of hand. That's another topic on another topic altogether. But what your car payments are, what your debt payments are, your student loan payments, when they're going to be coming due if you're on deferment. All of that needs to be put into a budget so you know how much you can allocate towards what you're comfortable with on a mortgage. Because what you qualify for and what you're comfortable paying may be two completely different things. And you don't want to get yourself into a tight spot. So we want to make sure we're doing a good personal spreadsheet, a budget spreadsheet, to know exactly what you can comfortably pay per month for your total payment on that mortgage. So that's first and foremost. We want to do that. If you need help with that, let me know. I'm happy to walk you through that. Second, if you need to save up money for a down payment or for closing costs, you can absolutely do so. I recommend that you save up money regardless as much as you can while preparing, because when you buy a home, you want to have some sort of an emergency funds. So if, let's just say, 6 or 7 months go in and your hot water heater goes out, you want to be able to, repair that. Or there are home warranties that you can get as part of the transaction that cover that. So we can talk about that in detail at a later date. But I recommend saving for at least the closing costs, because not every seller will be able to pay for your closing costs. Now, if you don't have the ability to sell, you're kind of tight, but you really want to buy a home and get in on becoming a millionaire, which 90% of millionaires started in real estate, then go ahead and start shopping for a home, but you're going to be limited on the properties that are out there to those that may have been on the market a little longer. So there's more negotiating power there to have the sellers pay your closing costs. So we can get creative with you. So don't let that shy you away from buying a home if you don't have any money at all. We just need to look at the market and those homes that are available a little bit differently. So definitely save up for at least the closing costs, which I said between $6,500 and $8,500 are usually the total costs associated. Building credit and boosting your FICO. So first off, always do a soft credit pull. Always, always, always when getting pre-qualified. I own FICOboost.com. So if you need to boost your credit scores, I literally own the program called FICOboost.com, where I can help you boost your credit scores and get them where they need to be to get into the game and qualify for one of these mortgages. You need to keep your credit card balances at 30% or lower. So what that means is if you have a limit on your credit card of $1,000, you don't want to exceed a $300 revolving balance on that. Now, if you pay them off every month, perfect. That'll get you really good scores. But if you're maxed out on your credit score, or maxed out on your limit on that credit card, you could lose 50 to 100 points on your score just because that one credit card is at its max limit. That has a massive impact on your overall scores. Now, your credit score is going to be the determining factor on what your interest rate is. So you want those credit scores to be absolutely as high as possible. So keep your credit card balances at 30% of what you can get on the max credit limit or lower. And do not go late on anything. If you think, I'm going to have to go late this month, it's not going to be a big deal, I'll pay it next month. Wrong. It's a massive hit to your credit, and it lasts a long time, and it's hard to recover. So do not go late on anything. If you have to borrow money to make a payment, do that. But when you're preparing for a mortgage, do not go late on anything. That is a FICO killer. And also, a lot of misnomers out there on credit. If you think that closing a credit card that you don't use is going to be better for you, you are wrong. A credit score is merely a report card on how well and how long you manage open lines of credit. If you don't have very many credit cards for a very long period of time, and you keep closing them out, we're going to show you only have a history of a small amount of time, which won't give you a good grade. If you have a long history of holding a credit card for a long time and having good standing with one credit line, you are going to have much better credit. So do not close out any revolving credit. Car payments, installment loans, those when you pay off, they automatically close. That's not what I'm talking about. I'm talking about credit cards like your gas card, your Lowe's credit card, your Home Depot credit card, your Costco credit card, those types of credit cards, your MasterCard, Visa, keep those open for as long as you possibly can so that you have very good history there. If you do have collections, I recommend if you're a year or so out, paying those off. Get them paid off now, because at first, it'll actually hurt your credit score by having activity on a negative account. But over time, your credit would build back up once those are off and paid. So we can talk about that more in detail if you do have any collections on your credit. Secured credit cards, if you don't have credit at all, and you want to know, Sean, what do I need to do to get better credit? You can get a secured credit card. Basically, you take $300 into your bank, say, I want a credit card against my own money. It's secured against your own money. There's no risk for the bank there, because if you don't make a payment, they have your money. They can make that for you. That's a secured credit card. Make sure they report those to the credit bureaus, but that's a great way to get started. Now, another way, this is a little hack. If you have a family member that has really good history on their credit, you can be added as an authorized user on their credit cards, and that'll instantly give you history for that account. It is a fantastic hack to get credit scores if you don't have them. And some loan programs, you have to have a credit score in order to qualify for them. So add yourself as an authorized user onto a family credit card, and that'll help you tremendously. You can also self-report. So you can put your utilities, your and a lot of bills, you can put those things like rent all on your credit report. And then you can get a credit score by doing that. So there's a lot of ways of building credit. But one of the things, I'm a big Dave Ramsey fan, except for the fact where he says you have to put 20% down, and that and you should never have credit cards. That I think he's missing out on, but that's a whole nother conversation. But he has a quote that I absolutely love. Live like nobody else now, so you can live like nobody else in the future. Meaning, be frugal now, so you can enter that pathway to being a millionaire by owning real estate. And then once you are a millionaire, you can live like nobody else because you're better and have more money and have more cash in the bank and more equity and more overall net worth than those that just rented their whole life. So live like nobody else so you can live like nobody else. One of the biggest things I see, and one of the biggest, I think, ways for you to prepare, do not spend a lot of money on a car. If you have an income where your car payment is going to be 10 to 15% of your income or 25%, don't do it. Try to get a cheap car that gets you reliably from A to B, buy a house, and then you can get a car once you have a house, you have stability. Because the biggest downfall I see with people coming to me to qualify is their car payments are absolutely killing them. Sometimes their car payments are more than the mortgage payment that they're trying to qualify for, which is wild. So cars lose value, not a good investment. Yeah, you can look fun and look nice for your neighbors and your friends and everything, and have bragging rights. But if you want to live like nobody else, so you can live like nobody else, that's the biggest thing I see that's hurting people when trying to qualify is their car payments. Student loans, try to get those under wraps, but for the most part, those car payments are killing a lot of people's abilities. So let's look at some benefits of home ownerships. Like, okay, you have a home, it's yours. I was thinking about renting, like what's the benefit of home ownership? And these may sound cliche, but they are absolutely true. So let's look at them. First, creative freedom. If you rent, you can't do anything to that house. If you wanted a garden, you can't do it. Or if you'd lose your money if you did it. If you wanted to knock down a wall, put in a pool, if you want to do, you can't do any of that. you're limited to your creative freedom within your household. If you want to paint, sometimes they won't let you. Establishing roots. You want roots, especially if you're building a family. It's nice to have a nice concrete set of roots. You're putting down a family. You're going to have a nice place to stay for a long period of time, and you control how long you're in that house. If you rent, they may say, you know what, we're going to sell, we're going to kick you out, and then you're done. Like, well, that was short-lived. You know, now you have to pick up everything and move again. And who knows what the next landlord would do. Establishing roots, when you own a home, you can be there as long as you want, and you make the plans. Tax advantages, there are write-offs for your income for the interest on your mortgage. So that will actually save you money. Another fantastic thing about homeownership. Building equity. Every time you make a mortgage payment, you're building what I call forced savings. You're putting that money in an account that's going to be yours for the future. So renting, you're throwing it all away. A mortgage, a large percentage of it is interest, but a other percentage of it, that goes towards your own pocket, and you're building equity. And every time that home goes up in value, you're getting a huge boost. Let's just say you bought a $500,000 house and it went up 3%. You're looking at $15,000 of free money you just made just on basic low appreciation. And that's a low figure. Typically, between 3 and 7% as far as appreciation goes. Usually it follows the inflation numbers that you hear from the feds. But appreciation is fantastic. And we've seen some great appreciation in the last 3 or 4 years. And if you didn't buy before 2020, you're kicking yourself right now, because looking at prices now. Now, stable payments. When you have a mortgage on a 30-year fixed, that mortgage payment never changes. Where we all know rents go up and up and up over time with inflation. And you could be pushed out of renting because now you're so much higher. But your mortgage stays stable. And as you make more over the years, you're going to be able to afford more and more and more, but that payment stays low. So stable payments is a huge benefit. Obviously, stability. You're not going to need to move everywhere. You have a place to go. You know that in 6 months, you're still going to be there. You can make long-term plans. It's just nice to be an owner and not a renter. So a big question I get now is now a good time to buy? You may have heard all of this doom and gloom for the last year and a half, even through COVID, on the market is going to crash. You heard it. I heard it. I didn't believe it, but a lot of my customers did, and they waited. Well, what happened? In 2023, we saw appreciation between 3 and 5%. Now, we did see it kind of flatten out and come down a little bit, and then it came back up. It's because of supply and demand. There's just not enough homes. I'll go over that in a minute. But the best time to buy is as early as possible. Kind of that question is, when's the best time to plant a tree? Well, it's 25 years ago. And it's the same thing with homes. When's the best time? 25 years ago, like when it was cheaper, because homes are a lot more now than they've been in the past. So I would say now, but we have to look at your circumstances. Here's a really good image that I wanted to share with you. Supply and demand. Supply and demand is the key to property appreciation. If there is a huge supply, but a very low demand, people have to lower their prices to sell. If there is a huge demand and a low supply, you can raise your prices because it's in high demand and multiple people are trying to buy that home at the same time. And that's where you get appreciation. Now, overall, the amount of homes being built is way too low. We're about $2 million homes short of where we should be as far as total homes for sale and inventory across the United States. I mean, it could be between 1 million and 2 million. We are very low. And what happened was down during COVID, even before that, during 2008, when we had the big financial crisis, which was not a real estate, it was more of a financial crisis that hurt real estate. The mortgage industry was terrible. Everyone could buy a house. They didn't have to show any proof of anything. It was bad. Times are very different now. Everyone can afford it because we prove it. But back then, builders stopped building. For like 4 or 5 years, no homes were being built. But people were still being born. People were still getting higher in age, and they're looking to buy a home. But the amount of homes didn't follow the amount of people and population. So now we have a huge deficit. So the amount of homes for sale, that low supply of homes for sale and the high demand is going to keep our values strong. So when you say, I'm going to wait, you can. You'll miss out on 3 to 7% of 500,000. You miss out on 15 to 50 grand. Do you really want to do that? Or would you rather buy now, get that money, and move forward? So that question of buy now versus wait, I've got some great numbers I can share with you. So you may say, well, home prices haven't always gone up. Let's look at that. Since 1942, there's only been 7 years where it's seen negative, and it hasn't been very much. Now, back in 2008, it was a big jump because that's when everything fell off the face of the earth, but it came back. But only 7, it's like betting on a boxer. If the boxer is 73-7, pretty much you're going to bet on that. That's going to be a sure win. So those are the only times where values went down. Every other year they went up. And look at that, between way back in the day, it was real high at the beginning. Then it flattened out. It was 1 to 2 to then 4 to 7%. Then it was 3, 10, 7, 16, 7, 10, 7. And then we had a little bit low. Then the next year we made up for it. As you can see, the pattern shows the values continue to appreciate with real estate. It's just the way it is. It's the nicest thing in the world. It's the best kept secret in the world is appreciation on your home. So keep that in mind because the numbers are powerful. We're going to go over those in a second. So if you're waiting for rates to go down, this is one of the funniest statements that I've seen the last 3 or 4 years is marry the house, commit to the house, but date the rate. Basically, you can buy the home now and rates will always go up and down. And when there's an opportunity to get a lower rate, you can do that and drop your payment way down. Qualify for what you can now, get into a home that you can qualify for that is in your comfort level. And then when the rates drop, it'll be even more comfortable because we're going to drop that down. Your mortgage rate should never, ever, ever go higher than the initial rate. It usually always goes lower over time because those opportunities will pop up and yours truly will give you a call to say, hey, it's time to save $250 a month on your mortgage. You've had it for 3 years. Let's do a 27-year to refinance at a lower rate. Let's drop your payments. Let's keep you on track. And then you're optimized throughout the life of that loan. So when you're saying, when you look at a 30-year fixed and you say, okay, my payment's going to be $4,000, rent's $3,600, I don't know, I don't want to do it. Remember, you're paying yourself, but over time, we're going to optimize that mortgage when opportunity presents itself. That's why we say date the rate. It's not going to be there forever. We're going to get you better rates in the future. But we're never going to give you a higher rate than what you have. That's fixed forever. But there are always opportunities to refinance. So marry the house, date the rate. I love that. Love that saying. So let's look at some rent versus buy, because at first, if you look at it, yeah, I can buy a home for $4,000 a month or something like that, but I can rent for $3,600 and save $400. Well, what does that do for you? What does that look like short-term versus long-term? Here's a couple scenarios. So I took a home in a neighborhood that was $4,500 in rent, which is a little high. It's a $650,000 home. And I put that together and I said, okay, well, what's the short-term and the long-term benefits here? So because of appreciation, because of you're paying yourself, so amortization, you're paying yourself every month when you make a payment, you're knocking down that loan balance, creating equity. Over the long haul, you're going to save, you're going to have a lot more benefits with owning. So over a 10-year period, by owning a home, you're $396,000 better off than what you were renting. And at the 3-year mark, now I count into this, okay, what if I had to sell the first or second year? That's all part of this. So I look at your cost to sell, we have commissions, we have everything in there. Over the long haul, what will you look like? And the appreciation gain, $225,000. Your amortization gain, you paid $94,000 to yourself instead of a landlord. So your total gain in here is $396,000. So huge benefits to buying versus renting. Another one, here's one at a lower price point. As you can see, your rent is less than buying. $2,230 versus $2,390. Rent is cheaper, but is it? Over the time, because you pay yourself, you're going to be building that millionaire portfolio over time, and you're going to have in 10 years a net gain of $199,000 over the next person. That's renting. So huge benefits long-term to buying. Yes, if you sell your home after the first year, you may have a loss because you have to pay real estate fees when you sell. But if you're looking to keep this home for a couple of years, then you can do so. Now, some of the fears that people say is, well, what if I lose my job? Well, you can always rent your house out and have somebody else pay your mortgage. So rents always go up. In fact, in the third year, rents are going to be higher than your mortgage on this one. So you can actually start making money in the future if you wanted to say, you know what? I want to rent, I don't want to sell, I want to rent this out and start making money, because renting a home is another way that those 90% of millionaires make more millions. So if you ever have the fear of, I'm going to lose my job, I'm not going to be able to make a payment, that's fine. If you lose it and you can't do anything and you have to move in with your parents or move in with a friend, whatever, rent that bad boy out and start making money on it. And that's the power of ownership. So there are some fears out there. A lot of times they're not logical. We can walk through those. Every circumstance is different, but it's definitely better to buy than to rent. So how do mortgage rates work? You may hear all kinds of things on the radio on what rates are doing. They're going up and down. The federal funds rate, what are rates? Well, for the most part, mortgage rates, they change daily. And I won't get too technical, but when you're shopping for a mortgage and you choose one day to call one lender, and then 2 weeks later you call another, it's never going to be the same. Rates change daily. And you can get any rate you want at any time. And guess what? You can ask the seller to help you pay money to buy down and get a lower rate. And this is what it looks like. This is a rate sheet. And it's hard to explain if you haven't been in the industry what this means. But if you look at the 6% rate that's down here, this isn't current, by the way. This is because rates change daily. But 6% in this circumstance doesn't cost any money. You actually get a $105 lender credit right here, that 105. You get a $105 lender credit to help pay for some of your closing costs. Now, you can get as low as rate as you want. So if you say, you know what, I can afford it at 4.375, great. Let's ask the seller to pay for this discount, this cost to get that rate. And that's what's called points. So when you hear the term points, discount points, you're paying extra money to get a lower rate than what the true market is at 6%. So that's what that means when you're paying points, and you can have the seller pay this for you in today's market. Not on every home. Again, that takes your real estate agent will help you with that as far as the negotiating. But you could get a much lower rate. So you can get any rate you want depending on a certain circumstance. And you can pay this yourself if you really were gung-ho. But rates always drop. They go up and they drop. So I would say don't pay a huge amount if it's your own money. If the sellers are willing to pay for it, great. But you can get any rate at any time. And look at this. If you look at the 6.125, a little higher rate, we're going to give you $2,000. And you can use that to go towards your closing costs. So there's some creative ways to help you with closing costs from the lender side as well. So let's go over some questions. Let me look at some of the questions we have here. What are current interest rates for the new home buyers, 30-year fixed? Now, credit score is going to determine your actual interest rate. Same with loan program. So right now, if you look at the perfect person that is doing 35% down, 800 credit score, you're probably going to see rates in the high sixes. If you're doing 0 down, the rates are a little higher. There's risk associated with that, so the rates are a little higher. So you're looking in the low 7s to high 6s on the first-time home buyer programs, somewhere in that line. Now, we have to, in order to quote rate, I need to get a lot more information. But that's if you look at Mortgage News Daily, which is a great website to go to see kind of what the average interest rates are. But they use the primo person when they're giving the quotes. Rate cuts will help the overall economy, and mortgage rates will come down in the future. It's not going to always come down in a perfectly straight line. You may see days where it gets worse, but you will see it eventually come down over time. But remember, marry the home and date the rate, because if you buy a home now and mortgage rates drop, I will refinance you into a lower rate with no lender fees. So don't let rate drive your decision on the timing of buying a home. We already have people like Fannie Mae. We have Mortgage Bankers Association predicting what the appreciation will be for 2024. It's between 4 and 7% across the board on all the people that are predicting it. Remember, it's because of the overall amount of homes for sale currently in inventory. Supply and demand. What are the pros and cons of a jumbo loan? So if you're buying $1 million house and you only have 10% down, you're going to be forced into a jumbo loan. Conventional loans, they will not go higher than that $766,550. There's no benefit. There's no difference really, other than, well, there is. Rates are slightly different, and the overall qualification is much more strict on a jumbo loan compared to a conventional. So that part of it can be frustrating for a lot of people because there's a lot more paperwork involved than a conventional loan. But I do most of that work. It's just your job to gather the documents, and that's the only really frustration with that. So if you're buying $1 million home, you're going to probably do a jumbo loan, but the rates are similar, and it's just the documentation needed and the requirements are a little bit higher for credit scores, etc. What is the average closing cost? Well, percentage is tough, because if it's a $700,000 home, I would say 1%, because that's about right in the middle of that $7,000 range. If it's a $300,000 loan, it's more like 2.5%, 2%. So it's more of a dollar amount, that's $6,000, $6,500 to $8,500, that you may want to look at. It does, as the price of the home goes up, that percentage drops tremendously. So it's not a good method to use percentage, but just expect $6,500 to $8,500 right around that range. If you're going above $1 million, it can be a lot more expensive. And then there was low or no cost first-time homebuyer programs. We discussed that. So that was one of the questions in registration. First-time homebuyer options for increasing credit score. FICO Boost is the program I own. I can help you boost your credit scores. If you have terrible credit and you want to know what you need to do to get to that next level, I'll give you a full report on what you need to do to get exactly the credit score we need. So it's foolproof. It's fantastic. So if you need that, I'm happy to help. Ways to save cost, credit boost about refinancing. We kind of talked about refinancing. That's where you get an entirely new mortgage at a lower rate to replace the higher rate that you have. Ways to save cost. Again, you can ask the sellers for contributing towards closing costs. But most of the costs associated with the purchase are flat fees for all of the different inspectors, title companies, escrow, everything that's involved with the loan. And again, like I said, with a little higher rate, the lender can give you credit towards that as well. We talked about the benefits of first-time home buying. Now, assumable mortgages. That was a question I wanted to leave to this, because assumable mortgages are something that is available. It's kind of a unicorn because they're hard to find those that work perfectly. But basically, any FHA or VA loan, just those two, for the most part, just those two are assumable, meaning if the seller of the house has a VA mortgage at 2.25%, even if you're not a veteran, you can take over that mortgage and the rate that they have on that mortgage and have a really low rate when you buy that house. That's called assuming their mortgage. You assume the terms, you take over their loan, and it is a fantastic tool. The problem is, if it's a $300,000 loan that they have, and you're buying a $400,000 house, you're only assuming 300. You need to get that extra 100,000 from somewhere, whether it's a second mortgage or you bring that cash in yourself. So assumable mortgages, if you want more information on that, that's a very deep topic. We can discuss that at a future date, but it is a fantastic way for you to buy a home at a very low rate. It takes some time to find the perfect seller to make it work, but it is a fantastic way. VA loans, my favorite loan, hands down. VA loans are 0 down. There's no monthly mortgage insurance, so you save that. They do have a funding fee, so depending on your eligibility and your disability factors, you may have to have that rolled into the loan. But VA loans are only for veterans and only for the individual that is buying the home. That is a veteran. You can't use your dad's VA benefit or your cousin's. It has to be for that person, for primary residence only. So VA loans, another topic, we can discuss that in a lot more detail, but absolutely my favorite loan altogether. So that's my home buyer webinar. I hope you learned something. And if you have any, can you have 2 VA loans? Yes. Let me explain that real quick. And again, we're going to do more Q&As here. So I was just going to jump into that. So if you have any questions, put them in the Q&A and I will answer them for you. So let me go ahead and answer the question about the VA loans. So let's just say you're a veteran and you're stationed in Southern California and you bought a house there, but now you're being moved to Florida at a different base, and you don't want to sell that house. You can get a secondary VA loan if you're being relocated, whether it's for work, for the military, for anything. If you're being relocated for any reason, you can get a secondary VA loan, and I'll explain how in a second, and keep that original loan and rent that out. Now, if you bought, this is a little bit more complicated, but if you're a veteran, you have up to the conventional loan limit for 100% financing. So currently, maximum conventional loan limit, $766,550. So let's use easy numbers. If you used $400,000 for the purchase, and there's now $366,550 left over, you can use that to buy the new home with zero down, and then the VA will fund 75% of the difference between what you have available and the purchase price. So you can still bring in very little amount when buying a home on a second time with VA. So very good question. And you can have an unlimited amount of them as long as you can qualify. So very, very good question. Any other questions for me? I've been doing this a long time, so if you have any random questions, even if you're not a first-time home buyer, any questions, I am an open book. I'm always here to help. You can always reach me on my cell, 480-322-4544. My website, WolandMortgageTeam.com. On that, it's a link tree. There's 5 or 6 different links you can get if you're interested in setting up a meeting with me, going to my website, checking out some different things that I offer. FICO Boost, all of that's in there at WolandMortgageTeam.com. And what credit score is needed to be for a VA loan? Great question. So VA and FHA loans don't actually have a credit score requirement. Now, most lenders have a 580 rule that they create themselves for that specific institution, but VA doesn't require a credit score. You just have to have good enough credit history and overall income and work stability to qualify. But again, most lenders have a 580 like line in the sand. So good question. FHA is very similar, 580, but there's no actual FICO requirement for those. Very good question. Can you have 2? Great job, Sean. Great being able to join you today. My pleasure. I'm glad you joined. Any other questions for me? All right, well, I'm going to stay on here just a little bit if you guys want to stick on and answer or ask any more questions. Otherwise, for those that did join and want to hop off, thank you so much for joining today. We're doing these monthly, and you go to livehomebuyerwebinar.com, and you'll be able to register and jump right on. So if you have any friends, family that are looking to learn more about the process, go ahead and send them here. I'm happy to take care of them. And again, nationwide except for New York and Hawaii. All right, guys, have a wonderful day.